You know that saying about those who don't learn from history? Well, our resources guy covers a story from his days as an exploration geologist in Zambia that perfectly illustrates why the mining industry seems destined to repeat its biggest mistakes. It's a tale of hubris, billions in losses, and the fall of the world's largest gold miner. Now, back in 2011, James had a front row seat to one of the most spectacular blow-ups in mining history, when even the savviest executives got caught up in acquisition fever. The parallels to today's markets, pretty striking. So, first of all, James, welcome.
Thanks, Woody. Good to be back.
Yeah, good to see you.
You
Take
too,
us
mate.
back to 2011 in Zambia. You were working for Equinox Minerals when the takeover frenzy began. What was it like being on the ground when these multi-billion-dollar deals were flying around?
Yeah, it was a huge time in the industry. So 2011, I would say, was probably that 1 year in my career as a geo which really stood out. It was a year when copper prices made their all-time high, and it was when these companies were really looking to pick up new copper projects. As most people would kind of recall, that China-led boom in the early 2000s, it was really led by iron ore. But then towards the end of that, the tail end of that boom, copper really started to spike higher. And there's this strong interest in gaining control of copper projects. So I was working for a copper miner at the time. The company was called Equinox Minerals. It was an Australian company, head office in Perth, but operations in Zambia. And I was exploration geologist, so I was looking around the project for new sort of deposits and sort of early stage exploration, soil sampling, drilling, that sort of stuff. Really at the center of copper and Zambia, this part of Zambia, which is really heating up amongst the big copper majors as a potential new frontier for big, large scale copper projects. Really in the thick of it for sort of the looming merger and acquisition activity that was about to kick off.
Yeah. You mentioned how every major mining company, Rio, BHP, Glencore, Barrick, they all got caught up in that buying spree. What makes you think that mining executives are particularly susceptible to that kind of cycle? Or why does that happen at this certain stages of the cycle?
Yeah, I think they're really prone to making the same mistakes as everyday investors. So perhaps that's an over bullish feeling of maybe that's just reading the headline news and taking that into their sort of broader analysis, which they shouldn't, but that's what the last mining boom showed, that a lot of these majors bought at the very peak of that last mining boom. So back to the Equinox example, Barrick walked in. Or initially, it was a company called MMG, a Chinese-owned company. They made the first offer. Equinox, to their credit, they knew the market was hot, and they fished the market for a higher offer. And it really didn't take much. And Barrick walked in with a sort of $7.2 billion offer. And I think it just sort of laid out the groundwork for what was happening at that time. So the majors were really in a sort of land grab for new copper projects and areas that were sort of more frontier locations. So not so much the established locations, but areas that could sort of offer huge new discoveries. And that's what Zambia was potentially looking like at the time. And that sort of fed into the sort of very speculative nature for these mergers, which were taking place in 2011.
Yeah, you do note that commodities, they do tend to provoke extreme reactions in stakeholders. How can investors spot this though spot when this emotional dynamic is starting to take over the market?
Yeah, so a big part of what we do with our free readership group and our paid readership group at Diggers and Drillers is really focusing on this commodity cycle. So what drives it? So from boom to bust, it's this continual cycle that's revolving from a period of underinvestment, lack of new projects, and then that feeds into a lack of new supply, which then drives higher prices, which then drives more developments and more merger and acquisition activity, and then eventually, sort of closer to the boom or the peak of the boom, you get a real strong flurry of M&A activity, which sort of it correlates with a lot of investor interest and these big companies paying way too much for these projects, and that's the peak, and a pretty clear peak. In terms of where we might be now, I think we're probably we're certainly not at that peak. We've seen a long period of underinvestment, which I think we'll probably touch on a little bit in a moment. So
Yeah.
won't go.
Well, let's touch on that now. Is that the key similarity carrying on right now? So we're not seeing the excessive optimism, and we're not seeing the big the takeover sprees happening that we were at the pace was in 2011, right? So what is the similar thing? Is it the recognition that underinvestment has been going on for a long time, and that needs rectifying?
Yeah, so I think it goes back to why I think 2011 was such an important year for my kind of understanding of the commodity cycle, and that's the information I try to bring to readers. So back to that example. So by 2012, that's when conditions really started to deteriorate in the industry. Across the globe, we talk about this buyer remorse setting in for the big miners. Barrick, the example, which took over Equinox, they announced a $4.2 billion write-down on the Equinox deal. So that's essentially the admittance that they'd paid about $4 billion too much for that project. And the CEO was fired, along with a lot of other CEOs. Rio Tinto, the CEO was fired after the company wore about $14 billion in write-downs. So this 2012, this was sort of the mark of the decline in mining stocks, and where these over big purchases really started to sort of the reality hit, I suppose.
Yeah.
And big write-downs. So this sort of really drove the big miners to tighten the purse strings, stop exploration, and really just preserve cash. There was no thought on growth. So everything tightened up across the board. There were mass layoffs, especially in exploration. There was no need for exploration. There's no sort of thought on the future at that point in the cycle, which was reaching sort of closer to the bottom. It was all about cash preservation. And that, I guess, really ties into the situation we have today. So that's the setup, that long period of cash preservation, sort of avoidance or reluctance to put money into future growth, which then sets us up for a lack of supply, which really does need to catch up if we're going to see this sort of the big demand forecasts, which we see with Benchmark and other analysts.
So just final question, bringing it to the current market, where do you see similar patterns of behavior emerging? Are there particular subsectors that you're seeing where you're seeing like 2011 style enthusiasm starting to creep back?
I think with gold hitting or continuing to hit all-time highs is a really good sign.
I think the index actually just hit 10,000 or something. I remember Brian, I don't know if that's right, Brian shot me an email earlier, and I just read it very quickly before we hit record, but I was like, oh, that's interesting.
Yeah, that's right. And I've said for a long time that gold tends to lead in commodity-wide bull markets, and we're seeing that today. Copper is not in that frenzy point yet, but it's still trading much higher than what it was 8 years ago. So there's a healthy dose of price appreciation in base metals like copper, zinc, tin, aluminium they're all sort of ticking along nicely, and I think sort of setting up towards a more bullish phase. And I guess the inevitability of that is really driven by that lack of investment and the fact that mines are a depleting resource. So you need to continually find new projects to resupply, and that can only happen with higher prices, and which then brings more investment into the sector. So I think we're sort of at a good point in the cycle for investors to look at stocks for sort of a long term, maybe 4 to 5 years.
Good stuff. And I guess the ongoing analysis will come in your new e-letter, the Mining Memo, which gives more timely week by week analysis and news stories. So if you haven't checked that out, please do so. Thanks, James. Much appreciated. You're going to be covering more of these experiences over the next couple of weeks, I believe, and I'll be looking forward to that.
No problem. Thanks again, Woody. Cheers.